So why is the market going a little poopy-doopy and squirrely today? Well, a lot of it has to do with what Goldman just said about jobs and what ADP told us, along with other uncertainties, like, of course, CoreWeave telling us that multiple of their data centers just don't apparently have enough people to complete their jobs, and therefore they have to delay revenues. And that was something that took away a little bit of a supportive toothpick for the economy. See, I've been of this mindset that the economy is sort of like this giant built-up dome of success right now. The problem is a lot of that support feels a little toothpicky, like there's not a lot of support to it. And the way we reconcile that is by looking at these actual jobs reports and trying to look under the hood to see, well, what's going on in here? What did we get this morning? What did Goldman just say? We're going to talk about that. Also, though, I got to shout out the Alpha report, because this morning, while the market was green on CoreWeave, or at least we were recovering here on CoreWeave, I said, don't trust the pre-market. I have a feeling institutions are going to dump CoreWeave and it's going to fall to this line right here, 90.07. It has not only done exactly that, and the Qs have gone red with this, which is something else we expected, but we've gotten a double bottom on that line. You actually watch my live streams, you'll see this happen. You know these lines have been there for a while. That's pretty remarkable. So if you don't have the Alpha report yet, go to meetkevin.com and join that. Make sure you get all the courses on building your wealth and the Alpha report delivered to you every day before the market opens up. So anyway, what's remarkable here is the jobs data and the economist warning on, hey, is it potentially time for a recession again? Nobody wants to hear that, but look at some of the Goldman data this morning. Goldman comes out, and the Wall Street Journal put together a good piece of this, but Goldman came out this morning and suggested that we might actually be at negative 50,000 jobs for this October jobs report. Now that's not good. That piece is right here. The U.S. likely lost 50,000 jobs in October, Goldman Sachs says. Now, that's their estimate. Now, remember, we're missing a lot of actual labor data, right? If we jump over to some of the numbers we were putting together this morning, we can actually see the trends of this. So first of all, look right here. These are all the reports we're missing right now. We are missing November, October, and September. Those jobs reports are missing. So the only thing we can do is we can look at the official labor reports for the United States. And this has been the trajectory of the official labor reports. Straight down. Usually once we fall under 100,000, we're pretty close to a recession. However, we just had a little bit of a wrench thrown in the gears. We had a massive deportation shift, a closing of the borders, and a huge change of immigration policies. As a result, what you end up with is this collapse in average jobs created in the United States, where in the last 3 months of jobs data that we've had, we've actually been at 29,000 jobs, which is pretty low. So if you look at the data here, from the beginning of the year on, so if we started January, we've actually been closer to creating about 74,000 jobs per month. That's collapsed down to 29,000 jobs per month in the last 3 months. Now that could be normal because maybe that's where the break-even labor report is. But negative 50,000? That would be well below the break-even rate and a warning sign if we actually get this. This is one of the reasons I'm bearish for after the economy reopens. I don't actually think that we're going to get the economy, like the government reopens. It's not the economy. The government reopens, and it's not like we're going to get the data right away. It takes a while to compile all of this. But once the data comes out, that's probably the biggest bearish catalyst that we have to get through. We have to get through that catalyst of getting all this data. Specifically, we're going to get the September jobs report and the October jobs report. Those are already due. And then we're going to get, in the first week of December, we should be getting the November jobs report, which will be right before the Fed meeting, which right now we are only pricing in a 67% chance of a rate cut. But if we end up getting a negative 50K October report, ouch, man, that's going to suck. And markets are going to panic over this. Now, there are details to this, and we've addressed this as well in the past on the channel, that people might try to add back in the loss of government jobs. Okay, Well, according to Goldman Sachs, the loss of government jobs was 100,000 positions. Well, in that case, you'd have a BLS October report that aligns at 50,000 with the ADP report at 42,000. But this is where we're kind of like, okay, well, which is it? Because when we look at the ADP report, we also get mixed signals on the ADP report. Because the ADP report on the weekly basis that we got this morning is like, oh, hey guys, the ADP report on a weekly basis between September 25th and October 25th is negative 11,000 on an, sort of a moving average basis here. But the ADP report for October told us we had 42,000 jobs, 37,000 of which happen in the Pacific Coast, mostly in tech jobs. So then it makes you wonder, okay, did we get a bunch of hiring at the end of October? Was there like a hiring boom in the last week of October that's not reflected in this year? Or were there a bunch of layoffs at the end of September? Like, what's going on here? Because now we're being told it's negative again. The numbers are all freaking over the place. And it's really annoying because it's like, well, which damn thing is it? It's like, yes, the ADP trend is trending down. Yes, the BLS jobs report is trending down. But maybe we can explain it away with immigration, and therefore maybe it's not that big of a deal. But of course, the big question then becomes, will it last? Well, that's where The Economist comes out and puts together a pretty interesting piece. The Economist argues that recessions have kind of become recessions are in recession. And there's this idea that because in history, we've had so many more recessions, like from the 1300s to the 1800s, we were in recession 50% of the time. Then we were in recession 25% of the time. Now, we've literally not been in a recession for over a generation, over 15 years. They say as many as 1/3 of American workers have never experienced a recession. And therefore, we might actually be experiencing a recession right now, which removes the sort of clearing of like dead and zombie companies, and then also increases pain, especially when you've got people who are more allocated to stocks than they've ever been before. But it also raises up zombie companies. So The Economist, they make this interesting point. There are three big problems that come. First of all, when you don't have recessions for a while, people forget that stocks don't only go up. This is why I keep advocating like pay off debt. Things are really noisy right now. We could teeter in either direction. 30% of American households' net worth is exposed to the stock market. We're at an all-time high with exposure to the stock market. Margin debt's at an all-time high. Credit card debt's at an all-time high. The government fighting recession is just going to increase massively fiscal deficits. And on top of that, the number of zombie companies that we have, even under high interest rates, is skyrocketing. I mean, we were just doing a little analysis on the live stream. We're like, dude, look at some of these zombie companies. QuantumScape, no revenue, net loss of $105 million. How do they actually stay alive? Because they issue stock. They meme up because they have quantum in the name. They have no revenue. And then they issue $250 million of stock because they're a freaking meme. Let's put that one away. Let's go look at another one. Rigetti Spaghetti Computing. Gross profit, $404,000 in the last 3 months. Kevin's gross profit is more than $404,000 in the last 3 months. This is insane. Rigetti Computing, okay, there are no real revenues here. This is insane for a company. Loses money, $20.5 million in the last 3 months, $17 million in the last 3 months of the same 3 months last year. Even more if you include the change in fair value derivatives. Where do they actually get their money from? Oh, they get their money from issuing stock. What do we have over here? Oh, look at that. $346 million of stock. This is how you get a misallocation of resources. You get meme stocks and you don't end up getting the flushing out of these zombie companies that don't actually generate money. So you have, here's another one, IonQ, $39 million of revenue, total operating costs, $208 million of operating costs. $82 million of it, general and administrative expenses. Yes, they spend 82 divided by 39. They literally spend $2 on G&A for every dollar of revenue that they earn. And so how do they stay alive? Not by making money. They stay alive by selling stock. That's all they do is they sell the stock. Look at this, $1.3 billion of stock raised. It's insane. Here's another one. What's this one? D-Wave Quantum Computing. What do we have over here? Well, let's just go see. Let the revenue speak for itself. D-Wave quantum computing, which is annealing quantum computing, which isn't really quantum computing. Total gross profit, $2.6 million. Loss from operations, $27 million. Net loss, negative $139 million. Where are they raising money from, these zombie companies? Well, let's go find out. Cash flow statement says, proceeds from the issuance of stock, $37 million, $536 million, $139 million, and that's almost $750 million out of thin air. Because these zombie companies take advantage of the stock market at all-time highs. And it's scary. Because let's just issue stock, it makes sense. But that's how you misallocate resources. You know, the stocks pump because, like with CoreWeave, you get a stock pump here because NVIDIA bails it out at, under $40. In case you didn't know that, by the way, it's another example of why you want to be part of the Alpha Report. You join once, you get lifetime access. But under $40, NVIDIA has a buy agreement for CoreWeave. NVIDIA is like literally a put option for CoreWeave under $40. And so every time they bounced under $40 or fell under $40 here, we're like, oh, NVIDIA is going to come buy them pretty soon. And, then of course they meme up to 187 because they can't go down. And so of course we haven't hit new all-time highs because that's the way momentum works. Is you hit your all-time high once off of momentum, and you typically don't make it back there because people, as the stock goes up, people try to take profit or get out, get another chance to get greedy and get out. So The Economist is not wrong to say we're in a recession right now, and people have somewhat forgotten of the pain of what could come. But, there are red flags. Look, for example, at the gold ratio. We were looking at that this morning, and we're like, the copper to gold ratio, and we're like, oh, whoa. We haven't seen this ever in the history of the copper to gold ratio. Look at this. The copper to gold ratio, which is usually where, fear goes up, so the price of gold goes up, or gold isn't getting bought through momentum, who knows. And then the price of copper goes down because it's an industrial metal, so the price of copper goes down because people are producing less. And then so what happens? Well, first of all, you get this ratio that usually coincides with things like the COVID crash, the 2008 crash, the dot-com crash, the Volcker era, right? So usually downturns in the economy are when this ratio goes down. There are other times as well, like over here in 2016, you had a little soft patch over here. Nowhere near as low as like what you get in a crash though, typically. You could see the 82 crash over here. We got the 82 dump over here. You got the 1980 dump over here. That's your double Volcker rug pull, right? And then in like productive eras, you tend to see an explosion of this. So you see, in 2005, you get this explosion of this ratio, or in 1988 as the economy's booming because the industrial metal of copper is doing really well. People aren't seeking shelter in gold. But who knows, maybe this ratio is just skewed right now, the lowest level in the history of the ratio. Like I could go back even further to like the 1800s. It doesn't get this low, it's insane. There's the lowest ratio ever, which is typically associated with a recessionary environment. It's like a canary in the coal mine. Now, I know we get tired of talking about jobs. There's no surprise we talk about it, I feel like on a daily basis. But it's reasonable to talk about jobs because, again, we got ADP jobs data this morning that isn't good. And then, of course, we have this negative catalyst now coming up. And the doomers just corrected themselves because just the other day, they're like, oh, we haven't actually hit levels of spending like we saw in the dot-com bubble for artificial intelligence CapEx. And I thought it was interesting because I'm like, I don't know, man, like these companies are, pretty negative cash flow right now. Now, I'm not calling for like a pop to the AI bubble tomorrow. Timing that is challenging. I don't want to encourage people to like go into shorts and get burned. I think shorting this market is really hard. So I think you're better off just like, if it's going to be a red day, sit out, right? If it's going to be a green day, like that's when you go in. This is more of my opinion. That's been our, like the trading strategy in the Alpha Report. Obviously, predicated on lines that we look for. Short if you want, obviously. But anyway, what's remarkable is when we actually look at what the Doomers just said, the Doomers just told us that S&P 500 firms relative to sales have not hit their 2000 levels. S&P 500 companies relative to GDP have not hit 2000 level multiples. But compared to net income, we've already exceeded the 2000 multiples. So it's sort of like, is this time different or is it all the same? It's a little doomery, right? So, I don't know. But what I would say is we now have to pay attention to this economic data that's coming out probably before the Fed meeting. They'll probably try to rush it out. And I find that to be, it will be a big clearing event. And so this is, I think, we might actually have the pendulum kind of flip, right? So the way to think about it is the pendulum flips on reopen, right? Once data comes out, we get September, October, and November in rapid succession for jobs. We'll literally be getting a 3-month moving average of data. You know how they're always like 1 month doesn't make a trend. Oh, we need multiple months or whatever to get the data together or whatever. Like we need a trend. You will literally get a new 3-month moving average, which is insane to get all of that at the same time. That is going to be, outside of Liberation Day, this could be the biggest catalyst of the year. And it could go either way. The trend is bad, but it could also clear the bad, because if, we add back in government jobs and the trend starts moving up again, it's not what we're seeing with Challenger, it's not what we're seeing with ADP reports, but technically you could fall towards soft landing. So this is a crazy catalyst. And I would argue is probably the riskiest time to be in margin, because if we get a bad trend, like let's put it this way, okay? Let's just analyze it. If the 3-month moving average goes to -25 to -50K, let's say, there's no way you can argue we're still at break-even labor, right? 0 to 20K, we can argue break-even. If we fall below that, it's recessionary. Now, what does that do? That gives us rate cuts, guarantees December cut, but it won't be enough. And it won't be soon enough either. So it's going to be wild. You could get some really nasty. If you have 3 months of -25 to 50, I would also argue you probably get your treasury yields down substantially. That's the other thing that'll happen, which is wild. But if that happens, expect the 10-year to plummet. And then what happens when the 10-year plummets? Well, then mortgage rates plummet. And if on top of that, then they come out with the 30 or the 50-year mortgage, dude, that's gonna be great for real estate. Great for real estate in low supply markets, like, the West Coast, where they just don't build homes. So that would be fantastic. The 50-year mortgage is already a tailwind for companies like House. I honestly think that's why we are currently at 3x the average rate of fundraising for House Hack. So in August, not all of these are fundraise dollars, but I would argue that it's probably somewhere around, I'll show it to you. I'll just put it up on screen. I would argue that it's probably 95% fundraising, this number, because we don't include rents in this bank account, because rents go into a different bank account. But look at this. This is crazy. I'll just put this up on screen. I don't think this is like proprietary information or whatever. But if most of this is fundraising, it's worth looking at it. So look at this. We're at 1.1 million in August, 881K in September, 1.4 in October. That gives you sort of a 3-month baseline, right? Dude, we're already at almost $1 million for November. That's crazy. And we're only, 10 days into November? And mind you, that I think includes 2 weekends and today as a banking holiday. Yeah, the 1st and 2nd was a weekend, and the 8th and 9th was a weekend. So 4 out of the last 10 days that banks have been open have been weekend days, and today banks are closed. So it's crazy. I mean, we're really grateful. Thank you, dear SEC and investors. Make sure to read the offering circular. This is not a solicitation, but I think there's some desire to just diversify away from markets and maybe margin right now. I don't know. And look at like a risk asset like Bitcoin. You've got this sort of bizarre situation now where Michael Saylor goes and buys. What did he just buy? He just bought like 400 something Bitcoin. And of course he, pumps up the price of Bitcoin beforehand. Where was it? Right here. 487 Bitcoin bought for $50 million. It's actually surprising that they weren't able to buy more than $50 million. That's kind of a low fundraise. Mind you, right before that, he tweets buy now, which is, I guess we'll call it outsider trading. Whatever. It's not market manipulation at all, I'm sure. But anyway, then buys, so he can, say, see, I was right. You should always listen to me when I say buy. And then every day after that, he's like, first, get the Bitcoin. It sort of turns into this like meme of like, buy Bitcoin. But as a risk asset, if Bitcoin is a little bit of a warning sign, you can see that despite all of this, it's been, at least in the last few weeks here, has been struggling a little bit. This is since October. Go to the day chart. Obviously, it's done very well since Liberation Day, as many things have. But this right here is interesting. So you got a little bit of an extended downtrend right here. And we really need to hold this line right here. I made it an orange line because I actually think it's a pretty legendary line. World of Warcraft reference. 102, 164. That's what we really got to hold here. Well, so far we've recovered, but I wonder how much of this was supported by Saylor buying. So, something possibly to be careful of. Somebody here in the chat Jackie just donated $5 to say, so are you shorting NVIDIA or Palantir or not, Kevin? Well, I mean, I don't know if you just listened to what I said like 5 minutes ago, where I said this is a very challenging environment to short. It's desirable to, because the numbers are crazy, right? But the thing is, if you get this data catalyst, then it's good. The market's going to rocket. And you could kind of keep the AI data spend going for a while. So I'm so midpoint right now. And usually I pick a side. But like if that data rolls over on jobs, yeah, man, it's all going to tank fast. Because then people actually start pricing in a recession, which markets are not pricing in a recession right now. I mean, how do we know markets are not pricing in a recession? Well, you could actually look at the projected rate for, the next multiple years. And the implied Fed funds rate, which if you saw a recession, you would expect it to go to zero, right? The curve for the Fed funds rate right now takes you down to from 3.7 in December to 3.5 in March to 3.25 in June to 3 in October, 3 in December of 26, 3 in 27, all of 27, it's at 3. All of 28, it's sitting at 3. So the curve basically goes, we go down to 3% interest rates and we stay there. That's it. That's what the market is assuming right now. So the market basically is not pricing in a recession at all. Because if you price in a recession, you would see a collapse of that to zero. Like if we were pricing in a recession next summer, you would see a collapse of that to a zero Fed funds rate. So from, 3.7 or whatever to zero. And then you'd see the curve come back up because people would start pricing in the recovery after the recession. So you'd see it go back to, say, 2% or something. None of that is in the curve at all right now. The fact that we are at a coin toss for December tells you nobody's pricing in recession. Hopefully not. It's kind of crazy, right? But yeah, no. The tough thing about shorting is it's if you're getting options, you're paying theta. If you're on margin, you're paying interest. And you're sitting there like waiting and hoping to be right. And there's no difference between being wrong on your timing than being wrong on the thesis. Like at some point, there'll be a collapse in valuations, but pinpointing that is hard. All I'm saying is we got a huge potential catalyst that could tell you that the time is now for the flip coming up in the next few weeks. So that's why I'm I urge caution. Be careful because it's such a huge freaking catalyst. And every time we get the data, it's worse. So far, it's just every piece of data on jobs is worse and worse and worse. The Goldman piece doesn't help at all. So somebody's asking here in the chat, when do you think we're going to get the data? Before the Fed meeting. So before the 9th. You'll know we're in recession when we start re-rating stocks. Well, that's the thing. It's like, financial conditions are weighed heavily right now off of the price of stocks and stock valuations. If stocks tank, then the last thing that's basically keeping us out of an official recession is gone. And then you'll probably accelerate firings as well. It's just a disaster. But the good news is, knock on wood, still make money with the Alpha Report every day. Come join us. No guarantees, but we do our best every single day. And that core we've called today just literally could not have been more perfect. In pre-market, we're going up. I'm leaning bearish. It's probably going to $90. Is there a chance it'll go to 105? Sure, but it's not the way I lean. Somebody bluntly asked me, what if we go up, Kevin? I go, well, sure, but that's not what I think is going to happen. And sure enough, we went straight to the line. It double bounced it. Now, the next test, by the way, will be what happens at close. Are institutions going to buy the dip, or are they going to dump? Well, you have to take a look.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.